So Ankit, let's start.
Okay, I'll just start that. So we're live on YouTube also.
Good afternoon, participants. As usual, we are back at the same time, 4 p.m. Sunday, and we will remain connected with you till 6 p.m. or 6:30, depending upon the question from your side. As I said, that it has become kind of a part of my life, part of our life, to research, prepare, and then deliver a webinar like this. I'm happy to say that the last evening, we conducted a webinar on a very, very special kind of webinar on the insolvency process for real estate companies. And we also tried to make it a case that this is the best option available for home buyers as well as developers, builders, real estate companies. That was attended by like too many participants, because this was a webinar which was general. It was not for professional use. It was for the use of home buyers. It was for the use of builders. And it was very convincing to them that under other options like RERA or like consumer courts, like arbitration, like criminal courts, there is nothing which actually will resolve the entire issue. It is only the insolvency and bankruptcy code which will resolve the entire issue, and that too for a long term. In those options, one can get some relief for himself, and that too in case the company is solvent and the promoters are ready to solve some of the issues. But otherwise, as a company, as a whole, as a project, there is no possibility that it can be resolved otherwise. So the questions were so many that we also had to convert that webinar into part 2, and that part 2 of that webinar, which will be very, very important in the as regards the professionals are concerned. So we would be explaining the entire process for CIRP of a real estate company, a developer, and that will be a very, very detailed kind of a process. Although the first part was more of a concept clarity for home buyers and builders, the second part would be a complete process oriented, which will be very, very important for all the practicing chartered accountants, insolvency professionals, valuers. So that I would say that in case next Saturday at 6 p.m., in case you would join in the part 2, that would be really helpful for anyone who actually would like to understand the insolvency of the real estate companies. So today's webinar is again part 2 of our webinar, which is the forensic audit under RBI guidelines vis-a-vis the transactional audit under insolvency and bankruptcy code. I have with me Ankit Goyal, who is the founder of AAA Valuation Professionals LLP, which is the valuer entity registered with IBBI for all asset classes. He's also a partner with AAA Insolvency Professionals, and he's also a chartered accountant and a registered valuer himself. Ankit would help us in collating the questions which are relevant to the subject, and we will again use the same format. After every 30 minutes, we will have the questions, and we both would try to answer the questions, the relevant questions. More questions are asked, so that's beneficial to all the participants. Scenario, as today we are on the second part, so I would like to give you a little bit of a recap. In the first part, what we delivered was the entire framework of fraud detection, reporting, dissemination of information under the RBI guidelines, the entire framework of declaring a borrower as a willful defaulter and the implications of that declaration on the borrower, how the fraud would be reported to the investigating agencies, including CBI, how the changed scenario brings more responsibilities on the auditors, how the chartered accountants has to be vigilant while doing any audit for those companies, those promoters which are under financial stress. The early warning signals were completely explained. the red flagging was explained, and out of my experience of the last 30 years, I even explained the various processes used by the promoters where the financial stress can be flagged by the auditors, so that the auditors are protected to a great extent. So while we are moving ahead, so this part we are only dedicated to the transactional audits under section 43, 45, 49, 50, and 66 of the Insolvency and Bankruptcy Code. These transactions are presently, most of the professionals would be interested, most of the promoters would be interested in knowing, and most of the committee of creditors members also would be interested in knowing that what all these transactions are. We also would share with you that we have so far an experience of filing more than 70 applications under these sections. We have handled so many forensic audit or transactional audit reports, and our experience that we have collated to that extent that we even have kind of standardized the names that we are supposed to use for all the beneficiaries, and also the flow of the application that is required to be filed in the NCLT before the adjudicating authority under each section. So if the time permit, we actually will go to that standard operating process and the flow of the application which is required to be filed under these sections. We also have researched on the case laws. Of course, not many on the subject so far, but then yes, whatever case laws are there, we have tried to locate and try to bring it and make part of this webinar. So this webinar is also done in collaboration with the ibclaw.in. The organization is doing a wonderful job in providing us the latest case laws and updates, and their commentary, their analysis of each case that I read is liked by many, and it is also liked by me. So in case we read their daily news, that actually will keep us updated as far as the judicial pronouncements are concerned. So coming back to the, we also would attend the, because there are questions that the last time people are asking, how do you appoint forensic auditors or transactional auditors? See, for the communication today, I would not be using the word as a forensic auditor. I would be using the word transactional auditor, because see, whenever I use the word transactional auditor, that means I'm talking about the insolvency and bankruptcy law. And whenever I am talking about the, whenever I'm saying about the forensic audit, then that means that I am talking about the framework of RBI. So I would like to share my screen now. And Ankit, is there anything else? Should I
yeah, I think you can please share your screen, and I guess we will start taking questions with the same format that we do every half an hour. We will take some questions. There are already some questions which have been posted on the question panel, but I think you start and then we will take some later.
Okay, so here we go, and my slide is coming as usual that you have the habit of looking at the slide. So this is the same model that we have. So we have today the transactional audit under IBC and practical difficulties and case law. The primary importance of this is very, because these are all the avoidable transactions or transactions under IBC. Section 43 deals with the preferential transactions. Section 45 deals with the undervalued transactions. Section 49 deals with the undervalued transactions defrauding the creditors. And Section 50 deals with the extortionate transactions. Section 66 deals with the fraudulent transactions. So like in case we have to just talk about all the transactions collectively, then the first question which is being asked is who can find these transactions and apply to adjudicating authority? So the answer is either resolution professional or liquidator, or both. Even there is a possibility that the resolution professional also files an application under these sections, and the liquidator also finds another transaction and files an application to adjudicating authority. There can be multiple applications to the adjudicating authority, so there is no bar on the applications or the number of applications or the number of transactions. In fact, whenever you find a transaction, immediately report that transaction by way of filing an application to adjudicating authority. I would come to this practical experience, which is very important, that it is not important that we should wait for the forensic or transactional audit report. And whenever we find a transaction which is worth reporting and where we are is worth getting some amount or some contribution, that should be reported as and when the transaction is found, determined, and you have the documents for reporting that. So even the RP can do it or the liquidator can do it, and both can also do it. RP can file multiple applications, liquidator can also file multiple applications. So if both together can file as many applications as possible. So what is our responsibilities? Our responsibilities are basically lies in section 25, subsection 2 and subclause J, where it is required that the RP will file an application for avoidance of transactions in accordance with chapter 3 of IBC. And then the regulation 35A provides for the various timelines. 75th day, we actually have to form an opinion about the transactions. 115th day, we actually have to determine the transaction. And 135, we have to make an application to adjudicating authority. And whenever we are submitting a resolution plan to the adjudicating authority, we also have to submit along with the resolution plan a report on the transactions under section 43, 45, 49, 50, and 66. And that's what is provided in regulation 39 sub regulation 2. RP also is need to mention about the applications filed and the pending or as order obtained in form H, which is a compliance certificate which is required to be submitted along with the resolution plan. So these are our responsibilities as a resolution professional, and as a liquidator, we also have powers. We also have powers and duties of the liquidator under section 35(1) subclause I to investigate into the financial affairs of the corporate debtor to determine undervalued or preferential, etc. transactions. That means all these sections are covered under section 35(1)(I)(1)(L) also. Then in case we look into the liquidation estate of the company, in the liquidation process, it is very clearly said that any asset or value recovered through proceedings for avoidable transactions to form part of the liquidation estate. So whatever money comes, it actually will be forming part of the liquidation estate. First question which comes on mind is, is it mandatory to appoint a transactional auditor for an insolvency resolution matter? So this is a very, very crucial question. And I have researched it to a great extent, but I haven't found any provision in the law, act, regulations, rules, where it is provided under the insolvency law that or any regulation that the IRP or the liquidator is required to appoint a transactional auditor or a forensic auditor. It is only under section 20 subsection 2A. It is said that the IRP or RP can have the authority to appoint accountants, legals, or other professionals. So in case we think that this resolution, the forensic auditor or transactional auditor is a professional, then of course we have the power to appoint. So then as far as the need to appoint is concerned, that's not mentioned anywhere that there is a need to appoint. The practical part is that the RP can be any person. RP can be an engineer, can be a management consultant, he can be a banker, he can be a company secretary, a cost accountant, or he's a chartered accountant. And not that all the chartered accountants are also expert in finding the transactions, avoidable transactions. That's also something which is a very, very specialized job, and it needs even technology. It needs a kind of the forensic lab for a good audit. For a good audit, it might even require a forensic lab. So first of all, it may see like, how do we say that there is no transaction? So in case we find a company where there is no transaction for the last 5 years, there is no bank account, or if there is a bank account, in the bank account also there is no transaction for the last 5 years. And I think in such cases, the RP can take a decision that since there is no transaction for the last 5 years, it is not required that I should appoint a professional. There is no transaction in the bank. There is no transaction in the books of account. So what is the need for appointing an auditor? And if I appoint the auditor, what exactly he would do? Because there is no transaction in the bank, there is no transaction in the books. Somebody can argue that there may be a possibility that beyond 5 years that some transactions must have happened. That of course will depend upon the committee of creditors. In case the committee of creditors would be interested, yes, that we should look into the past and that too beyond 5 years, then of course the RP will have to take a call and to appoint an auditor. Otherwise, RP can himself say that, yes, I would be able to understand the transactions by seeing the books of account, by analyzing the bank statement. Even the RP can do it himself. But like I have not seen RPs taking a decision not to appoint a transactional auditor, because then the entire responsibility would lie on the RP. So the RP would not like to take the entire responsibility. Today, the RP may decide that there is no transaction. Maybe genuinely he is not able to find any transaction, but later on, in case any transaction is reported by any other person, then there will be unnecessary blame on the RP that he actually have not appointed an auditor, and neither he pointed out the transaction, neither he determined the transaction himself, that actually maybe it is considered it is a connivance. So once to avoid any such kind of blame, it is advisable always to appoint a forensic auditor or transactional auditor during IBC, so that later on, in case any transaction is found or spotted by any other person, the RP should not be held responsible. Now, there are some cases where somebody says that the no books of accounts are available, so how can we appoint the forensic auditor? I'm saying that the books of accounts are not available, then we can even look into the bank statements. If the bank statements are available, then the forensic auditors are capable that they can convert financial accounts into some kind of books, so that they are able to find the transactions of diversion, transactions of using funds. So various transactions can be reported through the bank transactions in case the books of accounts are not available or the books of accounts are not provided to RP. So this is it's like there are many other cases when we talk about whether it is mandatory to appoint a transactional auditor or not. So let's say that in case there is no asset. So one scenario is that there is no books of account, and how do we get the audit done? So then I answered that yes, we can take the bank statement and we can seek the information from the committee of creditors, and then we can try to find out the transactions which are reportable, which are avoidable, which are fraudulent. But in case there is no asset, COC is not interested in continuation. There is no asset, there is no recovery possible. The COC says that no, there is no asset, so let's put the company to a dissolution or liquidation. So we don't want to spend money. So we are not interested in appointing a forensic auditor or a transactional auditor. What should be the duty of the RP then? RP should try to convince the COC that look, there is a scenario which is possible that somebody who's actually taken away all the assets fraudulently, diverted all the money fraudulently from the company, and today when the RP is appointed, the RP is not able to find any asset. That may not be seen as a reason that the company doesn't have any asset. There is no possibility of any recovery. So the promoters should be absolved from all the wrongdoings. That should not be the decision of the committee of creditors, and it becomes the duty of the RP to convince them that yes, there is a possibility that the assets are all diverted or assets are sold and misappropriated. So this is very important, that in case the company was running about 2 years back and now the company is not running, and we actually try to see there is nil asset, nil recovery possibilities, and we absolve the promoters from all the frauds or all the wrongdoings, and we don't find any transactions. So that's something which is not advisable. Coming back to the one that there is no asset, one there is no transaction, the RP should appoint a transactional auditor. The COC, how the COC can interfere? How the COC can interfere in the appointment process of transactional auditor? The first provision says that any professional which is appointed in a CIRP, the fee has to be approved by a committee of creditors. So while approving the fee, the COC interferes into the selection process. The COC would try to understand from you the process adopted. The COC would try to understand how many quotations that have been taken by you. And COC also would try to say that, no, we disapprove the fee and we only pay 50,000 rupees. So that means that the COC is not interested in actually get any appointment of any transactional auditor. Yes, it is very important that the COC has to ratify the fee. So therefore, the COC's indulgence becomes practically live. They would indulge, they will influence the decision of appointing a transactional auditor. The COC can also highlight certain events or transactions to the transactional auditor or the RP, and may would like to see the proper identification of the transaction. This is another way, this is another kind of COC. In some COCs that we see, that the COC will tell us that, no, we got the forensic audit done 6 months back, so there is no requirement of the forensic audit again. Then we need to explain to them that the audit under the RBI guidelines is different, and the transactional audit under IBC is different. Under IBC, under the RBI guidelines, there is no preferential transaction, there is no extortionate transactions, and even the undervalued transactions are also restricted. So, but whereas the scope of transactional audit is much larger than the forensic audit under RBI guidelines. However, there may be a possibility of shrinked period, because see, there is a look back period under section 43, 45, and 50. And although it has been held that there is no look back period under section 49 and 66, yes, but there is a look back period. Whereas in the forensic audit, the look back period would depend upon the bank's understanding of the transactions, bank's understanding of their disbursement period, or the kind of warning signals that they are getting. So they would try to cover all that period which was giving them the warning signals as per RBI guidelines, or which probably would be a period when the account was red flagged or a period before the red flag. So this, and then when we are actually trying to fix a fee for the transactional auditor, then the COC can also indulge into scope of work. The COC can also direct, no, we want the scope of work to be extended to 2010 onward when we disburse the loan. The COC can also tell you that they would like to shrink the scope of work. So that's something which is not possible, but yes, under the pretext of approving the fee of a transactional auditor, I have seen that the COC's interference into appointment of transactional auditor cannot be avoided. The COC will definitely interfere into the process. What we do normally, we seek quotations from international brands, we seek quotations from the domestic brands, established ones, and also from the beginners. And first of all, we give a chance to the COC whether you would like to get the audit done from international brands or mid-level firms or the cheapest one. So the COC normally gives us view in very quickly, no, they would like to go for the cheapest one. Or some COC says, no, we would like to get the international brand because of the assurance of no indulgence by the forensic auditor with the promoters. So that kind of experiences that we have seen in each COC, where the perspective is different, where somewhere the perspective is only to save money, somewhere the perspective is to get the best kind of auditing done and report all the avoidable transactions to the adjudicating authority. The RP needs to maintain transparency, therefore sharing the report with the COC members may be desired. At point of time, some people say that the sharing of report with the COC members is not required. No, I say that nowhere it is written in the act or in the regulations that the COC members should not get the copy of the report, and that too officially. And then also, because the COC members are kind of collective decision making with the RP, so they also need to understand whether the forensic auditor has done a good job or not. They also need to understand whether the job has been done properly or it is evasive of some information. So therefore, I would recommend that in case the COC members ask for the report, they actually should be given the report by the RP. there is a great difficulty about the disclaimers. Whenever we get a report from the from the transactional auditors, we find that there are a lot of disclaimers given by the auditor. And one of the very, very prominent disclaimer is that this report cannot be used by anyone other than the resolution professional or the liquidator in case he is appointed as the liquidator. Now, in this case, the COC members want this report because they have an official information when the forensic audit, when the transaction audit is done, they get an information that there is a fraud. And in case they get an information that there is a fraud, they actually have to go simultaneously under the RBI guidelines and report the fraud. So there are two simultaneous processes starts when the transactional auditor gives a report. Even if a draft report is given, that draft report is circulated to COC members, and the COC members immediately react. And they say that since we have got the information officially that there is a fraud, there is a kind of fraud which is expected, or there is a kind of accusation of fraud, so we should get it investigated. So they probably would immediately come in action, and jointly with the other group of creditors, they would try to report it to the RBI, depending upon the whether they are public sector bank or they are private sector bank. So in case they are public sector bank, more than 50 crores of fraud, they have to report to the joint director CBI. And in case the fraud is less than 50 crores, then they have to report to the other department of the CBI. And then if it is less than 25 crores, then they actually have to report to the state police, the economic offense wing, or the CID of states. So with this scenario, I'm saying the appointment of transactional auditor has been a very, very controversial issue in all the CIRP assignments that we are handling. Now, the management cooperation during the transactional audit is also very, very important. We have found that whenever we are asking for the information, so the first process is that the RP takes the control and custody of the CD, corporate debtor. RP's people start sitting at the office of the company. In some companies, there is no person employed in these days, and the RP take over the custody and finally locks the premises, or put a security guard, or keep an accountant there, and then the RP is working from his own office. See, when the transactional auditor asks information, then the RP tries to take that information from the X management, and I have seen the reply which is coming from the X management is that every record is available at the factory site. Every record is available in the computer which is at the office. Every record is available on the EIRP which is in the office. And our factory and office all are under the custody of the RP. So the RP should provide the information, not we. We don't have any information at our home, and we are not going to factory, not going to office. So why the information is being asked from us. So this is a very, very critical issue. Very critical issue. Like in case we have seen that we can find the computer, but maybe that there is no hard disk. We can find the ERP is installed there, but there is no password available. So all these difficulties that we are facing, that also means that the forensic audit, the transactional audit should not be started, should not be concluded. See, even if we are filing an application under section 19(2) before the adjudicating authority, but that has also not found a very, very encouraging results, because the information that is coming after the application is filed under section 19(2), and that also comes filtered, and the information is really not usable. Because see, the information, the forensic audit or the transactional audit can be done in case the raw data comes to the, or given to the auditor. Auditor also accuses the RP that the raw data is not given to us. We need dump, we don't need filtered data. And they would try to find it on from the dump. So they need always the dump of the data, and they don't need this filtered data. So we are actually facing a lot of problems in many cases where the ERP is not functioning because the fee is not given. See, even in the past, what we have seen in the banks are also not getting this kind of cooperation for the forensic audit. However, when the borrower is coming to the bank for any enhancement or any kind of restructuring or any kind of rehabilitation, at that time, the bankers were insisting for a forensic audit. And there was an incentive for the promoters to get the forensic audit done, because that would actually become the first condition for even starting discussions on the loan proposal or enhancement proposal or rehabilitation proposal or restructuring proposal. So at that time, the banks were getting the forensic audits done, and the promoters and the management used to give the information which is totally filtered, and the only information which is given to the forensic auditor which they want to give. Otherwise, no other information can be taken. That's very important. All understand that the information is with somebody else, and if I can find information forcefully, no way that I can find information forcefully. And even if I find dump digital data, it will be very difficult to get explanation on that data from any accountant, because even the accountants also would not report to RP. They would be loyal to the main MD, they would be loyal to ex-management, because they've been working with them for years, and they understand that the RP is only a guest in the company, RP is not the owner. I have also seen people getting the forensic audit done before the actual forensic auditor comes. I have seen people giving this kind of assignments to chartered accountants that I have to get my forensic audit done. So you please do my audit, and you also highlight the non-compliances or the faults, and also try to complete the documentation for all those things so that those are not considered as reportable. So that is also, which is important, that the people have been getting it done. See, before I move on to the preferential transactions and the remedies available under section 43. So Ankit, do we have questions like?
Yeah, I think there are some good questions. Let me just speak them out, and what we can do is we can answer them in a very short and crisp manner, because most of these questions are related to our practical experience. So a question from Sandeep Goyalji: in CIRP process, is a transaction audit or a forensic audit mandatory, or in what type of cases is it mandatory for the RP?
I think for the last 15 minutes, I'm speaking on this question, and maybe that this question actually came to you before this, because I've been speaking for the last 15-20 minutes on this part only.
So maybe he joined in late, so maybe we can skip it. Next, yeah. Mr. Avdut Kotwal, he says that does NCLT provide additional time for forensic audit or transaction audit apart from time limit prescribed under section 12 of IBC 2016? 330 days. He says that
no, there is no additional time. The transactional audit has to be completed by the RP. We have seen the practical experiences where the resolution plan has been submitted before even the transactions are determined, and the reasons are provided why the transactions were not determined, why the report of the transactions were not submitted along with the resolution plan. However, the RP has to work, the transactional auditor has to work on it, and the transaction, and in case there are any transactions determined, it has to be filed. However, this statement says that any transactions which are determined, in case the determination is done delayed because of any reason, then somebody can always say that I determined the transaction after even filing the resolution plans to adjudicating authority. So I'm doing it now after when I determined the transaction or when I located or spotted the transaction. So there is no time limit, but yes, as per regulation 35A, it is very clear that 135th day of the CIRP, we actually have to file an application to adjudicating authority, and that should be much before the resolution plan is submitted for approval. That's what is the mandate. However, with the reasons, somebody can find excuses and somebody can apply for any kind of delay which has taken place because of reasons not beyond the control of the RP.
So next question from CA Ajanta ji. The question is that do RP
your voice is low, Ankit.
Okay, let me just correct that. It should be better now. So do RP need to share forensic report to creditors, FCs, OCs, and the directors or the CD representatives, what is the requirement to share the report with the credit COC members, OCs?
So there is no such
CDs?
provision under the Act or regulation that it is required to be shared with the creditors, and there is nothing to debar also. So what I understand is that once this kind of an audit is done, the COC is empowered to approve the fee. The COC should understand the kind of report which has come. It is the COC who actually should be supervising whether the report is genuine or report is also in connivance with the promoters. So my understanding is that in case the COC is appointing a professional, then the professional's performance, the report also should be shared with the COC. And why not? Why not? Because see, the COC has suffered a loss because of the default by the corporate debtor. COC must know where the money has gone. In case the money has gone for frauds, the diversions, and the kind of assets have actually gone and manipulated. So all that must be known to the COC so that they can also take action as per the RBI guidelines or as per their own internal processes. I don't think there is any reason to say that the RP is not liable to share the report with the COC members. There is no reason. Should be shared.
Okay, so next we come to a question from, so basically, I think we have CA Janta ji reiterating her question that maybe the question is with respect to OCs and directors.
No, I think as far as these directors are concerned, what we do is that we get a draft report from the auditor, and then we confront the draft report to the ex-management, including directors, and we tell the directors and the ex-management that this is the report that the forensic transaction auditor is submitting, and it's a draft report. If you have to say something, you say. So in case we don't do that, then what happens, whenever we file an application to adjudicating authority, the ex-management will bring all the documents before the adjudicating authority and make a case that no such documents were asked from us, and we were not given any opportunity, and the forensic auditors and the RP jointly connived and filed an application against us. They have not even sought any explanation from us. They have not even sought any documents from us. So with this reason, we first share it with the ex-management, including directors. We seek their comments, and those comments also are incorporated in the transactional audit report. Then only the application is filed to adjudicating authority. Now coming back to the operational creditors. Operational creditors are not the members of the committee of creditors, and I don't think that is required to be shared with them. If anyone is definitely requiring it, so he has to explain the reason that why he wants it, why he wants to do that. So like in case he has to report a transaction, then we should tell that operational creditor that in case you have any information about any transaction where the promoters have manipulated the account, then you can report that to us. And in case we will find that this particular manipulation or fraud is not reported by the auditor, then we will confront them and we will get this report, get this investigated by them. Otherwise, it is not required that we should circulate the transaction audit report or even the copy of the application that we have submitted to adjudicating authority to all the operational creditors, workmen, employees. No, it is not in my understanding.
So lots of other questions. I think you can resume and then we will take more questions after some time.
All right, so let's focus on the preferential transactions, which are very important. And we see that the preferential transactions are normally found in most of the companies. Who can find these transactions and can apply to adjudicating authority? Yes, resolution professional or the liquidator or both. How many transactions can be reported? Multiple. How many applications can be filed? Multiple. So this is latest learning by us, that the multiple applications should be filed, and multiple as and when the transaction is found, if it is worth reporting, it should be reported separately by a separate application to the adjudicating authority. The relevant time again for the preferential transaction is 2 years in the case of related parties, then 1 year in the case of non-related party. So what are preferential transactions? The first condition is in the preferential transaction that there should be a transfer of property. Second, there should be a transfer of an interest of the corporate debtor. When we look into the Act, we found the definition of property, and which includes money, goods, actionable claims, land, every description of property. That means property means anything. So if there is a transfer of funds, transfer of goods, transfer of claims, claims means any kind of contractual rights, any kind of claim or contractual rights, anything that is transferred, anything which is property as defined under section 3, subsection 27, that is what is called property. Now let us understand what is transfer of an interest of the corporate debtor. And it is also important that when we see the property can be situated in India or outside India. Every description of interest, including the present or future or vested or contingent interest arising out of or incidental to property. So when we talk about interest, that also is there should be, it is important that it should be present interest, future interest, vested in the corporate debtor presently, or contingent, incidental to. So it has to be related to a property, any interest, and that is what is there is no definition of the interest in the code. However, it can be safely taken as ownership right, interests, or security interest, or beneficial interest, any contractual rights. That's what is the interest. So first condition that I am saying, that there should be a, let us again reiterate, the first condition is there should be a transfer of property or transfer of an interest of the corporate debtor within the look back period. So this is the first condition, within the look back period. So the property and the interest we have already seen. Now the second condition, that the transaction must have been taken, the transaction of transfer of property or transaction of transfer of an interest, that must have been taken place with a creditor or a surety or a grantor. So this should be the status of the parties with whom these transactions have taken place. So if any property has been transferred to a creditor, surety, or a grantor, or if any interest of the corporate debtor has been transferred to a creditor, surety, or a grantor, then this is called a preferential transaction. And that too, when the payment is made to such person, on account of an existing liability, on account of an antecedent pre-existing financial debt, or an pre-existing operational debt, or any pre-existing other liability, which is there in the books of account of the company or not, but that the liability is owed by the company to such persons. So far we have been able to find out three conditions. There is a transfer of property. Number two, the transfer of property to a creditor or a surety or a grantor. Number three, the transfer is made on account of any existing liability. May it be a financial debt, may it be an operational debt, or any other debt. So the three conditions are very, very important. And the fourth condition is that by this transfer of property or interest, we are putting that creditor or a surety or a grantor. Let's use the word creditor. So whenever we are using the word creditor, also assume that we are talking about surety or a grantor. So putting that creditor in a beneficial position. By making this payment, by making this transfer of property, we actually have put that particular creditor in a beneficial position than it would have been in the event of a distribution of the asset under section 53. Now suppose there's some funds available with the company, and the company immediately pay the money or transfer of the property to the unsecured loans, which belongs to family or related parties or associate concerns. So that means that some money was available with the company within the look back period, and the money was paid to the unsecured loans, and it was not paid to secured. That means if the company would have gone into liquidation under section 53, or if the company would have gone for the insolvency under section 53, the unsecured creditor would not have got anything before the secured creditor had got. So unsecured creditor had gained by getting this payment, or getting this transfer of property. And these people, these unsecured loans are, we have started calling them as beneficial creditor, because what we have collated here is the total experience of more than 70 applications that we have filed so far and various forensic audits that we have handled. So out of that crux that we have started calling these people as a beneficial creditor for the sake of standardization of the application that we are making under this these sections. Reiterating four conditions. First condition, there should be a transfer of property. Second, the transfer of property should be to a creditor. And number three, the transfer of property should be against an existing liability. Number four, by just transferring this property, the other person, the transferee has benefited as against his position under Section 53. So these are the four conditions, and these four conditions are important. All the four conditions are important before we actually call a transaction as a undervalued transaction. So before I go to the what kind of orders can be obtained, I will actually go, because this is something which is little technical. I'm saying, let me go and tell you, these are the most common preferential transactions. Payment to unsecured family loans during the look-back period while the debt of secured creditors is outstanding. Definitely it's a transaction which is a preferential transaction. Funds were available, the property of the company was transferred, it was transferred to a creditor, it was transferred against an existing liability, and this particular transfer give them a beneficial position as against the secured creditors, because the secured creditors are, the creditor's right is adversely impacted. Payment to old operational creditors. I'm not saying regular business payments. I'm saying the old operational creditors while the debt of secured creditors or unsecured financial creditors are outstanding. Operational creditors are even below from the unsecured financial creditors. So in case the operational creditors are given anything, any transfer of asset or money of the company has been given to operational creditors, then that means that has an adverse impact on the rights of the secured creditors and the unsecured financial creditors, because unsecured financial creditors and secured creditors are even above in the priority under Section 53. Payment to unsecured financial creditors may be as per the prefixed loan installments while the debt of the secured creditor is still outstanding. That also becomes a preferential transaction, because there is a possibility that some of the unsecured loans taken from the private organization where the promoters have given post-dated checks, and the promoters are normally interested that these payments should be made so that they should save themselves from the rigors of Section 138 of the Negotiable Instrument Act. So that way they may pay some of the unsecured creditors, some of the unsecured financial debt only because to save themselves. So that's also a preferential transaction. And I'm saying to that extent that the payment of any tax against the order of any authority would not be a preferential transaction, because this is specifically mentioned there that the payment of any tax against the order of any authority would not be a preferential transaction, because that's not something which has been done voluntarily by the promoters or by the management. That has been done by an order of the court that the money should be paid. Money should be paid, that has been done. So that's not. However, payment of regular taxes, direct or indirect, would not be considered as a preferential tax also. So what is not preferential transaction? One, that in case any order has come and based on that order we are paying the taxes. Secondly, we are paying regular taxes on the current income or current transactions. That also is not a preferential transaction, even if the tax authorities are much below as compared to the secured or unsecured financial creditors in Section 53. Even the payment to workman and employee in the regular course of business would not become a preferential transaction, because the payment to workman and employee is also considered to be high in the priority and also considered to be the which is the regular course of business. So any transaction which is done during the regular course of business cannot be considered as a preferential transaction. Let's talk about some more transactions which are considered as a preferential transaction. Payment of secured debt against which the property of the directors is mortgaged would be considered as a preferential transaction. You actually would see a scenario where the payment of a debt has been made by the company because one of the personal property of the directors have been mortgaged against that debt. So that also will become a preferential transaction that was done by the promoters only to get that property saved from the bank. So that is also a preferential transaction. Payment to a secured creditor in priority while the debt of the other secured creditor is outstanding is also a preferential transaction. I have 10 secured creditors, and out of the 10 secured creditors, I paid to 1 only, or paid to 2 only, or to 3 only. Then it is a preferential transaction, and the orders can be obtained from the adjudicating authority, where the money can be called back from these secured creditors and can be allocated to all the secured creditors in their debt outstanding ratio. Payment to those creditors who have security of the post-dated checks signed by the directors would be considered as a preferential transaction. Like in case I'm doing some transactions only because I have signed post-dated checks, and I have seen most of the promoters are making payment only because they want to get rid of the 138 of Negotiable Instrument Act. So therefore, those transactions are also preferential transactions. Payment of old tax dues where there exists a risk of prosecution without any order from a court or authority may also be considered as a preferential transactions. So in case in the last 1 year, if any huge payment of taxes has been made, which is an old outstanding, and the promoters were scared that in case they don't pay this payment, then they would actually be facing prosecution. Or alternatively, just to get rid of the prosecution, the huge compounding was done by the income tax department or the service tax department or the GST, and that compounding fee was given out of the corporate debtors funds. That also can be considered as a preferential transaction because that was done and the property of the company was transferred. There was an existing liability, and the benefit, the tax department got benefited against the other creditors. In priority, tax department is 5th priority, whereas in this transaction they got the top priority. So that's where the preferential transactions falls. Adjustment of debit balances of debtors with the credit balances of other parties would be considered as an assignment of debt. So in most of the cases, what is happening is there are some debited debtors and there are some creditors. When we get the balance sheet, last balance sheet, the parties are adjusting the debtors with the creditors. They are saying that we have now adjusted the parties just by journal entries. And so they don't understand the implication of this. Now, the implication of this is that the sundry debtors is an asset of the corporate debtor. And that asset is being transferred to a creditor. That means the debt is the debtor, the asset is assigned to a creditor. So that means a property of the company, which is a debtor, which is a receivable, that property is transferred to another creditor against their existing liability, maybe with document or without document. I have lost an asset which was appearing in my balance sheet and it was recoverable as per the auditor's certificates, and that I have assigned to a creditor. That means I have given a benefit to a creditor. I have given a benefit to a creditor who otherwise is very low in the priority under Section 53. So in the case of real estate companies, we have also found that the real estate management, the company's management keep offering flats or plots to all those creditors who have supplied goods or services or who have given unsecured loans. Those also are preferential transactions, because one, that so far the home buyers are unsecured financial creditors. Operational creditors are at the 6th priority, whereas the unsecured financial creditors are at 4th priority. So that means that there is a upgradation in the priority, and then the benefit goes to that particular creditor who has been given the flat. Secondly, there is a big thought going on, and we also advocate that thought, that the home buyers are secured creditors because they have, as per various definitions in the IBC, as per various definitions under RERA, as per various definitions under the Transfer of Properties Act, they in fact has a right of specific performance, and right of specific performance is one of the security interests as defined under the IBC. The right of a specific performance goes to a home buyer from the company, and the company is the security interest. This is called security interest. So Therefore, allotting a flat or a plot to an unsecured loan or to an operational creditor is also a preferential transaction and must be reported. Okay, so the judgment which was in the case of Anuj Jain, who is an interim resolution professional for JP Infratech Limited versus Axis Bank. This is the latest judgment on the transactions under Section 43. The judgment is dated 26th of February 2020. Now, this judgment actually gives a lot of responsibilities to the RP, and the duties and responsibilities are defined under Section 43. So it says that in the first place, the shifting through the entire cargo of transaction relating to the property or an interest of the corporate debtor backward from the date of commencement of CIRP and up to the preceding 2 years, that has to be seen by the RP. That has to be seen by the RP and have to found. Second step is to identify the persons involved in such transactions and put them into two categories. One category is the related parties and the other category is the remaining person. So what is the first responsibility of the RP as per the Supreme Court order? First responsibility is to find out the transactions in the last 2 years. Although there are orders that even slightly before this 2-year period, there are transactions, so the orders have come that slightly before the 2 years period is also covered. Then identify the person and divide this person into two categories. One is a related party, another is non-related party. Then it says that the RP ought to identify as to which of the said transaction of the preceding 2 years the beneficiary is a related party and which of those transactions where the beneficiary is not a related party. So first of all, find the transaction, find the person concerned, divide into related and unrelated, and the transactions also should be placed into related party transactions and unrelated party transactions. Then the unrelated party transactions shall further be trimmed into the transactions of the preceding 1 year. So unrelated parties, the transaction should be only restricted to 1 year. Related parties, the transaction should be actually continued to be identified for 2 years. As such, the other aspects such as undervalued and fraudulent, since this is not considered in this order, it is not very important to discuss. And in this case, which is an NCLAT judgment dated 20th of February 20, K.L.Jute Products Private Limited versus Tirupti Jute Industries Limited. So what is said in this case, the relevant part is that the aim of Section 43 of the code is to protect the body of interest over whom an undue preference was given in favor of other creditors, and the transactions can be called as preferential ones entered into by a corporate debtor, wherein a corporate debtor gives undue preference to a relevant time to any person. So there is a transfer of property that we've already explained. In case of a fraudulent preference, the dominant motive of a debtor in effecting transfer to a creditor or other is to be seen. So there is a little bit of motive is also to be seen, the fraudulent preference. So the term transfer includes sale, relinquishment, exchange, and an adjudicating authority under Section 49 of the code can restore a status quo ante in a given matter by protecting the person's interest. Section 49 of the code prescribes no time limit for securing an order in respect of a transactions entered into were meant to be defrauding the creditors. Now, see what these sections are trying to say. This is trying to say that in the case of K.L.Jute and in the case of another judgment, which is the Vittal S.A. Abhishek Nagori, who is the name of the liquidator, versus Asian Natural Resources India Limited, and this is also latest judgment, 29th May 2020, and it is from NCLT Indore. I think primarily this judgment was based on this judgment of NCLAT, where it is said that the transactions under Section 49, which are having some fraudulent objective, there is no look back period. And this judgment is probably used in this case, where it is said that there is no limitation period for fraudulent transactions covered under Section 49 and 66 of the code. So now we have established in NCLT case that in the case of section 49 and 66, there is no period. So when we get an audit done, and we should seek an audit period where the transactions can be found. And the audit period should not be restricted to 5 years. It can actually go back to even 10 years. It depends what kind of fraud. So what is written in this order is that the intent is that once a fraud is always a fraud. The maxim, fraud vitiates every transaction into which it enters, as well as to contracts and other transactions. So it's very clear that the transactions wherever there is a fraudulent intent, and the look back period is not important. Section 49 and section 66 doesn't provide for any look back period. So it's very important that we should understand that look back period is only for transactions which are purely section 43 or 45 or 50 transactions. For other 49 and for 66, there is no look back period. In most of the cases, like undervalued transactions and under preferential transactions, although I have a slightly different opinion, because when I read section 49, whenever I read section 49, it starts with like this. It starts with where the corporate debtor has entered into an undervalued transaction. I'm reading 49, subsection 1. As referred to in subsection 2 of section 45. Subsection 2 of section 45 is primarily an undervalued transaction. It is not talking about section 43. And the adjudicating authority is satisfied that such transactions was deliberately entered into by such corporate debtor, then it will be a fraudulent transaction. So I doubt that section 43 is covered under section 49, but yes, 45, which is undervalued transaction, is definitely covered. However, we have these two orders where the fraudulent transactions are considered to be, see, the preferential transactions with the fraudulent intent are considered to be an item of section 49, which I slightly differ in case we read these transactions very clearly. In this case, like, which is Tirumala Balaji Alloy Private Limited versus Sumit Benani, and again dated 13th of November 19, NCLAT has said that the transaction was entered just before a period of 1 year. Just before a period of 1 year. That was in the case of Monet Ispat and Energy Limited, where two related parties got a lot of refund of loans, and that too with an interest of 18%. So it was said that it has to be brought back. These transactions would be considered as preferential transactions, and these transactions are not supposed to be outside the look back period. And it is said that if the transaction is just beyond 1 year period and the transaction is with the related party, it is important that the transaction should be covered under preferential transaction, and the look back period can be extended slightly. Look back period can be extended slightly. So we have explained what exactly is the section 43, what are the transactions under section 43, and orders which has been so far given under section 43. We have seen the look back period, we have seen the fraudulent intent, we have seen the guidelines to RP regarding related party, unrelated party, bifurcation of the transactions to related party, unrelated party. For the unrelated party, the period should be further cut down to 1 year. And then we actually have to file an application to the adjudicating authority. So while filing an application, what kind of prayer we should make, what kind of orders can be obtained from the adjudicating authority, we are precisely on that sheet now. So the moment we understand what kind of orders can be obtained, then we'll finish 43, and then we'll open the forum for the questions in this part of the webinar. So we are already like the second 30 minutes have already gone. So we would definitely seek the questions. So the orders can be obtained based on the facts of each case. One order that which is very, very simple is that the property transferred in this connection can be vested back into the corporate debtor. Very simple. Whatever has been transferred, that should be brought back to the corporate debtor, and automatically RP or the liquidator will disburse according to section 53. Second possibility, any property to be so vested with the CD if it represents the application either of the proceeds of the sale of property so transferred or the money so transferred. Now, there is a possibility that whatever was transferred to the beneficial creditor and that has been sold, or it is not possible that property can be vested back to the corporate debtor, then the proceeds of the sale of that property so transferred, that can be brought back, or the money so transferred can be brought back. Third possibility is that the release or discharge of any security interest. In case I create a security interest against someone, suppose there is an unsecured creditor and that person is very close to the promoters, and the promoters have known that the company will go to insolvency. So there is an asset available with the company which is not mortgaged to any bank. So the promoters can say under an arrangement with that person that this particular asset is charged to you and the security interest is created. So that is also a preferential transaction under section 43. So the security interest was created to a creditor in priority to the others. So that security interest was the order can be obtained to release and to get a discharge on that security interest. The order can be obtained against any person who got any benefit, and that the benefit whatever has been received by any person. Then in case any guarantor got benefited, the guarantor got benefited because whose financial debt or operational debts owed to any person were released. Now, suppose I gave an example to you that one loan is granted by the director, or checks are issued by the director, or any personal property of the director is mortgaged. So the company can quickly pay that in priority to the others. That also is a transaction under section 43. So that guarantor who got this benefit, that guarantor who got that preference, and to that guarantor would bring back that asset or bring that benefit and will undo that transaction. And similarly, the securities or similarly any kind of possibility, the transaction is determined. So practically the RP and the RP and the adjudicating authority would find which is the best way to undo this transaction depending upon the facts of the case. So that particular order has to be obtained. So all these transactions have been seen, but then we actually would see like there are persons who are protected from such orders. Who are those people who are protected? So first is these kind of orders shall not affect any interest in the property. So in case any third party has acquired an interest in the property from a person other than the corporate debtor, any interest derived from such interest and was acquired in good faith and for value. Now, if I somehow get an asset of the company assigned to me, I get an asset from a company assigned to me, I being an unsecured financial creditor, I get an asset and then I sell that asset. And whenever I sell that asset to a third party, so that third party is protected because the third party has actually purchased that asset from me in a good faith and has paid the value. So that person is totally protected. So the adjudicating authority cannot direct that person who bought that asset from me for value and in a good faith. Secondly, the adjudicating authority shall not require a person who received a benefit from the preferential transaction in good faith and for value to pay a sum to the liquidator or to resolution professional. That person would also not be impacted. So what kind of transactions are not considered as preferential? The first we have seen that what kind of persons are not, orders cannot be taken from against such persons. Now, let us see like what kind of transactions are not preferential transactions. So first, transfer made in the ordinary course of business or financial affairs of the corporate debtor or the transferee. Very, very simple, ordinary course of the business. That means for value paid, that means at arm's length transactions are not considered as a preferential transaction. Any transfer creating a security interest in property acquired by the company to the extent that a new value is created or new asset is created and security interest is created on information utility within 30 days. Now, if I take a new asset, if I buy a new asset and I create a security interest on that asset, that's a new loan, that's a new value that I have created. And if I have created a new value, even if it is within the look back period, that would not be a preferential transaction, because the other party who has done the transaction, it's one, that it's an ordinary course of business. Second, that the security interest was created against a new value that has been created. Suppose the company has got a new value of 25 lakhs of asset, and the 25 lakhs of value has been, any interest on the security has been created. So that's something which is sorry. So then the provided that any transfer made in pursuance of an order of a court shall not preclude such transfer to be deemed as giving of preference by a corporate debtor, provided that any transfer made in pursuance of the order of a court shall not preclude such transfer to be deemed as giving of preference by the corporate debtor. Now, in case I got an order from any court and that order says that I have to make a payment or I have to transfer an asset to someone, that is also not covered as the preferential transaction. Of course, these are the explanations that any person who had sufficient information of the initiation of the CIRP and is a related party, those are not covered under these assumptions. So see, these are like the assumptions are not applicable to some people. The assumptions are applicable to some of the ordinary course of people. So here we, because we also have limited time and we have to take questions, I would like to conclude section 43, and I would like to request Ankit to provide me the questions for section 43, or even otherwise also, because this also works as a break and also involves the participants into the entire deliberations. And we have finished 43, and we have also finished generally the practical experiences. And now we will start this section 45. And before that, we'll take some questions.
So one of the questions is from Mr. Sandeep Gupta, and he says that what happens is that he says sometimes to run a business, you have to make payments which are, and when funds are scarce, money is scarce, you make payments to certain certain services and products which are required to run the business. And similarly, in case of TDS, non-deposit of TDS is a criminal offense, so it is deposited. And even he's saying, so like even if these payments have been made to keep the business in running condition, will they be treated as preferential?
No, I'm very clear. I mean, I also said that in my presentation that these transactions which are in the normal course of business that are not supposed to be preferential transactions.
But then certain examples that you gave was with respect to the compounding fee that is paid. So that again, you can't say that that was essential to run the business, because that was perhaps
that was
essential
only for
to save the director.
Yeah, yes. But I also gave an example, the current taxes, the payment of current taxes is not preferential. Payment of anything which is a normal course of business is not a preferential transaction. And to keep the company as a running concern is also not a preferential transaction. And I can tell you very, very specifically, during various CIRPs, I have taken the claims from various operational creditors. And while the company was a going concern, and even after taking the claims during CIRP, we have been making payment to them, and they are supplying fresh goods to us. So we are making payment to them, they are supplying fresh goods to us. So that way, the company is still going as a going concern. And finally, when we see everything is, the most of my claims of the operational creditors are kind of getting churned, and still there is an outstanding, but the earlier claims that they filed during the beginning of the CIRP, those figures are not matching, and now there are different figures. So those are also not considered as a preferential transactions.
Right. So next question from Mr. Rakesh Prasad, that is one payment to a payment made to a secured creditor, creditor. Can it be understood to be a preferential treatment because other secured creditor was not paid while one was paid?
Certainly, I said that. I said there are 10 secured creditors, and out of the 10, only 2-3 are paid. So there are various cases pending in the court where the one person actually deducted some amount, or during CIRP has been recovering some amount from, and the other people are suffering because he actually has taken away some money because the account was being operated with them. So now the scenario is that this is a preferential transaction. Certainly, it's a preferential transaction.
Then so loan was taken from related party and in the look back period, and it was repaid in the same year in which it was taken. Then also it will be treated as preferential payment.
I think we need to understand the documents. If the documents are like this, that yes, the loan was taken for a particular period and it was documented, and that documented, there was a complete record, and then if it is paid, I don't think it would be considered as a preferential transaction, because the amount was raised, it was raised for a specific purpose, and it was paid during the look back period itself. So that would not become. But then somehow, if it is a clean loan, if it is without a document, that means that the money was available with the corporate debtor. That money could have been paid to the secured creditors. And because since there was no responsibility of the company to pay back that money within the 3 months or within 2 months, still it was being paid. So that still can be considered as a preferential transaction.
So then, so whether RP can appoint any CA or other professional as transactional auditor, is there any specific qualification or experience which is required from such a professional to be appointed as transactional auditor or forensic auditor in case a fraudulent transaction is found by the IRP-RP?
So first of all, I said that any chartered accountant or any expert, any private limited company who is doing this forensic audit can be appointed. It is not even important that we should have a chartered accountant. So there is a possibility that some private limited companies are doing forensic labs. They are doing forensic kind of audits. Maybe that they have multiple people. They have MBAs. They have chartered accountants. They have the technology people. So those companies can also be provided. They can be appointed. The public sector banks are still preferring those people who are registered with IBA, Indian Banking Association. But otherwise, there is no such requirement. It is only for the sake of the process of selection. See, how have you just determined that this person can do? So in case we find a person who is not even empaneled with IBA and he is good in auditing, we can appoint that person. It is only the COC has to approve the fee.
So then there are transactional questions mostly, where I think most of that has already been discussed by you as to, you know, the waterfall mechanism and what can be preferential over the other payments that are required to be made.
Very nice. I think we can move on to the undervalued transactions.
Yeah.
And undervalued transactions, section 45, then the remedies available that we'll discuss in this part. So who can find these transactions and can apply to adjudicating authority? There is a difference in undervalued transaction. One has to be very, very carefully, in case you would listen. This is important part of the presentation, that who can find these transactions and can apply to adjudicating authority. Resolution or professional or liquidator, RP or the liquidator is a natural thing, which is for all other transactions also. And the application will be filed under section 41, subsection 1. In this case, section 45 is very specifically saying that the creditor, member, shareholder, partner of the corporate debtor can also file and apply to adjudicating authority in case it has been reported by in case it has not been reported by the RP or the liquidator. So in case a shareholder or a creditor finds an undervalued transaction, they can also directly file an application to adjudicating authority. And that application would be under section 47 subsection 1. And this is very serious, that in case any such transaction is found by any other person other than the RP or the liquidator, and the application is made to adjudicating authority, that means actually this will be a case of, then it will be a case, the IBBI would actually start the disciplinary action against the RP or the liquidator. The look back period again is the same as for section 43, related parties 2 years, unrelated parties 1 year. So let us understand the transactions under section 45. So the first condition is that the corporate debtor makes a gift to a person. Now the only the thing that I want to discuss is the gift. When we say gift, it can be a virtual gift also. It can be a resultant gift also. So it is not something that I sign a gift deed, and by just making a gift deed, I am giving a gift to someone. In case we go to the Income Tax Act and we say that what are the gift definitions of the gift. So in the Income Tax Act, we actually see that in case we transfer a property which is less than the value of that property, and that also is considered as a gift. So the gift doesn't mean that the gift by just shaking hand and by handing over to someone a gift check. That's not the only gift. The gift is also a virtual gift or a resultant gift. So enters into a transaction with a person which involves the transfer of one or more asset. Now the transfer of one or more asset is very important. Transfer of one or more. So the first condition is that there should be a transfer of one or more assets. Second condition is that for a consideration, the value of which is significantly less than the value of the consideration provided by the corporate debtor. So the consideration is much less than the value. Such transaction has not taken place in the ordinary course of the business. And the adjudicating authority might take an independent expert's help to assess the market value of the transaction. So whenever these people who actually got some benefit by getting a property of the company at a lesser value, those people in our application, we have started calling them beneficial transferees. So in the case of section 43, what we started calling them for the sake of our own SOP, and then that's what I feel that this also makes understanding better, because they are the beneficial creditors. So now the beneficial transferees, because they have got a transfer of some kind of property of the company. So we actually try to say that the gift, one is a gift made by the person, and second is the transaction of a transfer of one or more property at a value which is much less than the market value of the property. So these are undervalued transactions. What kind of orders can be obtained from the adjudicating authority? We'll go it later, because first of all, we try to understand the all this part we should not understand. We should understand what are the transactions. But then along with this section 45, we also need to understand section 49, which is the undervalued transaction defrauding the creditors. Now, what does it say? Section 40, the transactions as defined under section 45(2), that is undervalued transaction if deliberately entered by the corporate debtor for keeping the assets of the corporate debtor beyond the reach of the creditors, or in order to adversely affect the interest of such creditor. So in case there is a gift, or in case there is a transfer of an asset. Now the third condition is that it is done deliberately with the intent to keep the assets of the company beyond the reach of creditors, and the interest of the other creditors is adversely impacted. Then such transactions are considered as a transactions for defrauding the creditors. And I've already read various orders where there is no look back period for section 49. So in case we find any transfer, or we find any kind of a gift which is virtual or resultant gift, all these transactions can be considered in case it is deliberate, and then the deliberated transactions are considered to be fraudulent, and then the orders can be passed by the adjudicating authority, restoring the position as it existed before such transactions, as if the transactions had not been entered into, by protecting the interest of the persons who are victims of such transaction. So section 49 talks about this. Section 49 talks about this, that this is a transaction with the intent to defraud the creditors. Protection of a person who have acquired in good faith and for value paid and without any notice of the relevant circumstances, that is very well mentioned. The Vittal essay Abhishek Nagori, we have already seen that while the look back period is there for undervalued transaction, but for section 49 there is no look back period. So let us understand some of the most common transactions that we have come across in our experience of last 3 years, and while handling about 70 such transaction applications. And then I will go back to the various possibilities of orders from the adjudicating authority. Okay, the most important transaction that we found under section 45 is the sale of fancy and expensive cars owned by the corporate debtor to related parties or unrelated parties at a value which is much less than the market value of the car. Whatever is the car that we see in the fixed asset register, and then we feel happy, yes, there is a big cars available in this company. When we finally see those cars have already been transferred to some people, and that's what is normally found as an undervalued transaction. Secondly, the sale of very fancy offices or any other valuable property of the corporate debtor to another related party or unrelated party at a value which is much less than the market value. They would use the circle rate and they will get it transferred to any other company. The moment they see the possibility of CIRP, they would do these transactions. Third, if there is money available with the company, they give loan or advances to related parties or unrelated parties or associates without any business objective. Now, these kind of transactions would be covered under section 49 because these kind of transactions are having the intent and this has been deliberately transferred to the parties, so that in case they would not transfer it to the parties, then the money would go to the creditors. So they never wanted that the asset of the company should reach creditors. So they actually transfer it. Whatever is available with the company, they would transfer it to the related parties or unrelated parties by just giving loans or advances. Now, while they would show it as a loan, or advances which is recoverable, or the intent behind the transaction would be defraud. So the transaction would be basically with the intent to defraud the creditors, so that these transactions can be immediately reported to the adjudicating authority. And as we have seen, the orders that can be passed, and the orders are very clearly restoring. This is the order, restoring the position as it existed before such transaction. So these important transactions should be reported quickly. Transfer of good franchises to another person at a value which is much lower than the actual value. So we handle some cases where the business of the company has been running through various franchises. So there are good franchises, there are bad franchises, there are closed franchises, there are running franchises. So when the CIRP is beginning, when the CIRP started, we have seen even the agreements have been entered into the backdates, and the franchises are being sold to other related or unrelated parties. So I have restaurants or I have some other stores. So when the CIRP is imminent, then I can transfer some of the good franchises to any other company, and the valuation, of course, it's very difficult to value, and the good franchises are transferred. So these also can be considered as a transaction under section 49, and the earlier position can be restored by the adjudicating authority. And the other very common undervalued transaction that we have seen is the shares of subsidiary companies where the business is running or business is lucrative or the assets are lucrative. Those shares are being transferred to other companies, related companies, unrelated companies at a price which is much less than the actual value. So these transactions are also covered under section 45 and 49. So it is not always important that the only one section is applicable. We can always apply section 43 and 49 and 66. We can always apply section 45 and 49 and 66, because wherever there is an intent to defraud the creditors, then we can even apply section 49 and section 66 both. So the transactions are mostly overlapping. So there would be a transaction of undervalued, which actually would have fraudulent intent. So that's transaction which is covered under both the sections. So it should be covered in both sections in the application. Then the transfer of brand, trademark, copyrights, which are owned by the corporate debtor to any other parties related or unrelated, so that the value is protected. Transfer of intellectual property rights, software, patents, digital assets, all these are assets. And is normally you would see that it has been transferred to related or unrelated parties at a consideration which is much lower. These are the transactions which can be covered under section 45 and 49. 45 and 49. A combination of these two sections is a very good combination. And you can always say that the intent of the X management was to keep the asset away from the creditors. Keep the asset away from the creditors is what is written in section 49. Also, it is written in section 66. So when the transaction is done with the objective to defraud the creditors, that's what is covered under section 45, under section 49 and 66. Some more examples of the transactions, undervalued transactions. I would actually say purchase of any asset at very high value to keep the funds of the corporate debtor away from the creditors. Now, there is a possibility that within the group, we have another company which is dying company. And dying company, the shares of that dying company where there is no business with, that's a zombie company, the shares of that particular company, which is in the minds of the X management is almost zero. All the shares are transferred to the corporate debtor, and the shareholders of that company, which is a dying company, they get the money from the company. So a dead asset has come to the ownership of the company, whereas the people who were holding the shares of that dead asset, dead company, they got benefited. This is also a transaction of undervalued. So they see, although there is a concept called the transfer of an asset, and then the second is the gift. So if I'm purchasing an asset, if I'm purchasing an asset of 5 rupees and I'm paying 50 rupees, so that means the 50 rupees that I paid and the value that I got of 5 rupees, 50 minus 5, 45, that would be considered as a virtual gift to that person. That would be considered as a virtual gift to that person if I'm purchasing an asset at a very high value. So this is very important, and it's not something that it has been held in any kind of order or a rule or a judgment. It is an understanding of gift by a corporate debtor. Gift by a corporate debtor can be in many ways. Virtual gift, I'm talking about the virtual gift, or I'm talking about the resultant gift amount, where the transaction is for purchase, transaction is for something else, but it actually ends up gifting someone some money, some asset, some value. That is also covered under the undervalued transactions. So the other example is settlement of dues of associate concerns or other parties at a value which is much less than the due amount, would be considered as an assignment of an asset at a value which is less than the actual value of the asset, would also be covered under section 49. Because I suppose I have to take something like 1 crore of rupees from some associate concern or from other party. I settle with them as an X management. I settle with them that instead of 1 crore, you give me 20 lakhs of rupees. I will give you a settlement deed and you give me the balance amount in cash. That's also an undervalued transaction, because while settling a due, I have gifted something to some person, which is not a normal business of the company, and which is also with the intent to defraud the creditors. Then I'm writing off some of the debtors or advances without justification or reasons or efforts to collect money, because I keep on selling my goods to some fake parties only to reduce my stocks. Because see, what is the normal acts done by the management which is under financial stress? First of all, they try to show rosy picture. During the process of showing a rosy picture, they would increase their current assets, that means stocks and debtors. And while they finally come to the CIRP, they would try to bring it down. And when they try to bring it down, that means that they will try to write off the sundry debtors or advances. So when they write off the sundry debtors or advances without any justification, without any reason, and without even giving complete KYC of those debtors, that also can be a section 49 item, because that's an item which is a kind of passing on a benefit to someone, which is considered as a gift under section 45 and can be reported to adjudicating authority under section 45 read with section 49. As I said already, buying the shares of an associate concern for a value which is much higher than the actual inherent value of those shares. I've already said this is the transaction would be considered as an undervalued transaction, would also be covered under section 49. Then buying dead assets of the family or associate concerns to keep the asset or money of a corporate debtor away from the creditors. Now, the family might have an asset which is under litigation. The family might have an asset which has got a face value, very high face value, but the inherent value is very low. The family can decide to take away the money of the company by just transferring that asset to the company. And that also would be considered as a gift, as a virtual gift. And that virtual gift would be again reportable under section 45 read with 49. Sale of unsold inventory by real estate company before CIRP at a price which is less than the market price. This is for real estate companies. The real estate companies can also sell the unsold inventory just to defraud the creditors at a value which is much lesser than the value, the market value. Sale of the inventory at lower value as compared to the actual value, because you would see that this inventory, which is normally, I give an example of 200 crore stock coming down to 20 crores, then coming down to 2 crores within 2 years, and finally when the RP went there, it was not even 20 lakhs of rupees. From 200 crore story to 20 lakh story, and that's what is considered in that process. Some of the asset, which is an actual asset, can be shown as sold as a scrap. And that can also be reported as a transaction, which is an undervalued transaction, because the stock was having this much of purchase value. It was carried in the books of account for that particular value. The stock auditor verified the value. The statutory auditors verified the value. The banks verified the value. And now somebody suddenly says that the value was exorbitant. It was valued at 200 rupees per piece. Now I have sold it for 2 rupees and I have sold it as a scrap without any reason, and without any reason for carrying that particular stock in the books of account for that value of 200 for 3 years, and now selling it for 2 rupees. So that is also a case of selling the inventory at much lower than the actual value. So I would actually be coming back to the various, because see, let's understand the phoenixing also here. See, the concept of phoenixing I would like to explain here, which is phoenix is a mythological bird which burns itself and rise from ashes with renewed youth to live through another cycle. That's what is being done by some of the management of the companies, where the management believes that the company is not going to be saved, the company will die, because the debt of the company is not something that we would be able to service. So, however, the business of the company is still profitable. However, the business of the company can still make some profits. So then they resort to phoenixing. That's what is called phoenixing. In the international insolvency law, this word is being used very regularly. However, in India, it is not being used very regularly. And the phoenixing is when the company is being burnt, when the bird is being burnt and a new bird is created. So the phoenix is being created by just burning the existing company. So what is the modus operandi? The modus operandi is first of all, a new company is created. A new company is created, and the ex-management would approach the customers that we will take the orders in this new company now. This company has been started by my friend or my relative, and we will take the orders in the name of new company, and mostly the customers will oblige. The customer will be assured that this company will supply the material in the same manner, same terms and conditions, same brand, same quality. The manufacturing will also be done in the same company. Everything would be discussed, and the orders would be taken in the new company. So the first thing which is assured by the ex-management or the management under financial stress is to keep the revenue of the company away from the creditors. Gradually, they would transfer the big chunk of the revenue to the Phoenix company, and the earlier company is now kind of burning itself, and the management would be responsible for that burning the earlier company. So the new Phoenix is coming out. Gradually, the management will get success, so they will get most of the orders in the name of the new company. So the second step, as a second step, they would start purchasing the raw material in the new company, and they would send the raw material to the old company on job work. And see, in the process now, what has happened is that the revenue, the sundry debtors, the stocks, now everything is now out of the main company, which has taken loan from the banks. And the current assets have shifted to the Phoenix company. Now, the money which would be paid to the old company, that would be barely sufficient for paying the electricity bills and the workers' wages. Most of the technical human resources would also be transferred to the new Phoenix company, and gradually the brands and that means that the entire profit, technology, customer, everything is transferred to the new company, which is a Phoenix, and the old company that would be left for the creditors, old creditors. So that means that the ashes would be left for the old creditors. This is what is called phoenixing. So this phoenixing is very, very prominent, and this phoenixing can also be covered in some kind of undervalued transactions, because whenever we see such transactions happening, some assets are being transferred, some technology is being transferred, some copyrights are being transferred, can be brought under the undervalued transactions. That's very important, that in case we see these transactions like this. Now let's see, we have seen the transactions of undervalued. Let's understand and kind of orders that we can obtain from the adjudicating authority. First order that we can say that is to declare such transactions as void and reverse the effect of such transaction. Require any property transferred as part of the transaction to be vested back to the corporate debtor. Release or discharge any security interest granted by the corporate debtor. Require any person to pay such sum in respect of the benefit received by such person to the liquidator or the RP. So all this like 48(1)(c) talks about the benefit also, so that when we talk about the benefit, that means that the virtual gift or the resultant gift or the benefit that somebody has got, that also can be the order of the adjudicating authority, where that person is directed to pay such sum to the liquidator or the RP. Require the payment of such consideration for the transaction as may be determined by the independent expert. Of course, that talks about the expert. Under section 47(1), also to restore the position as it existed before such transactions and reversing the effect thereof in the manner to declare such transaction as void and reverse. And in that case, where the transaction has been reported by a shareholder or a creditor to the adjudicating authority, then the IBBI will initiate disciplinary action against the RP or the liquidator. So these are the orders that we've already said. However, there is a protection of those people who have purchased these properties in a good faith, and they have paid some good value, and they have got no notice of the company is under CIRP. So those people are protected. So this is what is the, we have already discussed section 45 and 49. So now I would like to take the questions for section 45 and 49. Then I will move on to extortionate transactions. Yes, Ankit.
Yeah. So one question is that if unsold flats are sold at stamp value and from purchase bills of builder, I think this is...
I think the purchase bills of the builder, I have already explained that when the operational creditors are getting some flats allotted, it's a preferential transaction. because the operational creditors are being upgraded to allotee, and allotee has a better status. So it is an upgradation of an operational creditor. So it's a preferential transaction. And if the unsold inventory is being sold at the circle rate, that itself is not a transaction unless an expert values that property at a higher value as against the transaction value. Circle rate transaction cannot be considered as a lower value unless there is a valuation done which says that the circle rate is much lower where the market rate is much higher. So we have to compare with the market value and not with the circle rate. And even if the property is sold at circle rate and the valuer has valued it at much higher, by also giving some instances of the higher sale value, that can still be a transaction of undervaluation.
And there's a question from Mr. Vivek Sethia. He says that his question is with respect to encumbrance. So he says that if some asset is already encumbered with one creditor, then if corporate debtor encumbers it again with another debtor, I don't think this is a very practical scenario because you don't have two encumbrances on the same property.
No, this is a fraud which is done because we have many cases where the one asset is already encumbered and then the charge is created on the same asset.
But in this situation, the person who has created the charge without the proper due diligence, or who that person will suffer.
That person will suffer because then of course it's a fraudulent transaction. It's a fraudulent transaction.
So then there is a question that what if flats are sold at very low price to third parties? And I think we've already talked about this.
We've already answered this.
We've already answered this. How CCDs, NCDs, intercorporate deposits between associate companies or sister companies have to be dealt with in relation to preferential transaction aspect?
I think each and every creditor has got its priority under Section 53. It may be from the related parties. It may be from associate concerns. If an associate concern is a secured creditor and this is a genuine transaction of a secured creditor, then of course, if anything is paid, that would be compared with the other secured creditors. So if that has been paid while the other secured creditors have not been paid, that still becomes preferential, because if there are 10 other secured creditors and one is the NCD, and the NCD is paid, which is taken from the associate concern, maybe against a security, but then one secured creditor is paid, other 9 are not paid. It's a preferential transaction.
There's a question from Priyanka Thakkar, how to prove the intent under Section 49?
The intent is that we are saying that the intent is to keep the asset of the company away from the creditor. So one situation is that the promoters had the information, because it talks about the twilight zone, which I'm coming to the fraudulent section, and because I'm only worried about the time, which is again like it's almost finishing, and I have to move on to the fraudulent transactions. I have to just discuss the concept of twilight zone. So I think in that process, all these questions can be taken up. But
I think we can. You can continue, and we can then take these questions.
So see, very little time that I will spend on the extortionate credit transactions, because see, like when we say that the PUFE transaction, which is the name given by the resolution professionals only, PUFE, preferential, U, undervalued, the F, fraudulent, E for extortionate. So PUFE doesn't become complete in case I don't discuss extortionate credit transactions. Although it's not much of the transactions have been found, we have not found any order of the extortionate credit transactions so far. Section 50 deals with this, and it only deals with the report has to be given by the RP or the liquidator. Extortionate transactions are where the CD raised financial or operational debt within the period of 2 years, and that to the terms of the transaction is very heavy. It is very exorbitant. So it actually is exorbitant, means that it is the kind of extortion kind of a scenario. Those transactions can be reported, and the adjudicating authority would pass an order directing the other party to relax the terms of the loan, and whatever benefit has gone to the lender, that also can be reversed and can be brought back to the corporate debtor. And the terms are unconscionable under the principles of the law. So like not many transactions, but then yes, we have the orders can be taken from the adjudicating authority where the restoring the position at existing prior to the transaction. and to set aside the whole or part of the debt created on account of extortionate credit transactions. Modify the terms of the transactions, require any person who was party to the transaction, or repay any amount received from such person. However, the provisions of these sections are not applicable. This is very important. The provisions of section 50 is not applicable to any person providing financial services. That means that in case I am taking a loan from an NBFC, and the NBFC can give me a loan at 30%, 35%, 40% interest rate, nobody can challenge that because they are in the business of providing financial services. If I am giving the credit interest of 30% to credit card companies, that also nobody can challenge because this is financial services provided. Like again, some of the examples of extortionate credit, taking unsecured loan from parties at an exorbitant rate of interest with and unfavorable conditions, while the corporate debtor is under financial stress. The suppliers stipulating monopolistic terms of supplying goods on credit. Borrowing from employees, directors, or associate concerns at a very high interest rate is also an extortionate transaction. However, credit card loan from NBFCs are not kind of extortionate transaction. And coming to the fraudulent transactions, of course, the section is very small, but it actually has got very wide implications. So the fraudulent transactions, the most important, most fearful transactions, that's something which is considered to be fraud. Again, resolution professional, the liquidator will find these transactions. The transactions, what are the transactions with the intent of defrauding the creditor? The only word which is written in section 66(1). 66 subsection 1 talks about the transactions with the intent of defrauding the creditors. Business of the corporate debtor has been carried on with the intent to defraud the creditors or for any fraudulent purpose. This is what is the word which is again and again mentioned here in section 49, also with the intent to keep the assets away from the creditors. And in section 69, the transactions are being undertaken. Transactions are undertaken with the intent to defraud the creditors. The business of the corporate debtor has been carried on with the intent to defraud the creditors for any fraudulent purposes. So again and again, the same words are repeated, defrauding the creditors with the intent to defraud the creditors. That's what it is. Now, coming to section 66(2). 66(1) says that part. Now, let us see what section 66(2) says. So this is what is called transactions during twilight zone or twilight period. Section 66(2) says when the transaction has taken place before the commencement of insolvency, when the director knew or ought to have known that there was no reasonable prospects of avoiding the commencement of CIRP, and such director or partner did not exercise due diligence in minimizing the potential loss to the creditors of the corporate debtor. During the twilight zone, the directors has been given an additional responsibility. And that additional responsibility is that they actually have to do the business with due diligence. And in case there is a possibility of, they have to work diligently to minimize the potential loss to the creditors. So this is a very important section, and that too during twilight zone. Twilight zone means at that time when the directors knew that it is not possible to avoid CIRP of the company, so they might enter into some transactions which are not otherwise fraudulent, but those transactions have not used normal general business acumen of the directors. Those transactions can also be considered as fraudulent under section 66 subsection 2. 66 subsection 1 is different. 66 subsection 2 is different. 66 subsection 1 says that with the intent to defraud the creditors. 66 subsection 2 says that during the twilight zone, you actually have to be more diligent to minimize the loss or to the potential loss to the corporate debtor. I think it's a very big section that actually has to be understood, that there is an additional responsibility on the directors. Nobody can say that this money doesn't belong to me, this money belongs to the CIRP, RB, and the creditors will take away my company. So whatever money is available in the company, I have to just lose those money in fraud, in transactions which might be transactions of fake sale or purchase, which might be transactions of just giving some kind of exorbitant advances, finally not recoverable. Those transactions cannot be finally to selling the stocks of those parties who are not giving their money back. So those are the transactions which are being done during the twilight zone, and the directors have not exercised due diligence in minimizing the loss. In this case, the directors of the corporate debtor shall be liable to make such contributions to the assets of the corporate debtor as the adjudicating authority may deem fit. So this is something which is called the concept of twilight zone. So what we are trying to say is, coming back to the fraudulent, first section says, section 66(1), that the transaction should be only with the intent to defraud the creditors. Second section says that the transaction, even if it is not with the intent of defrauding, but then the diligence has not been used during twilight zone, those transactions are also covered under section 66 subsection 2. And then the adjudicating authority might even pass an order, and the contributions by the directors can be ordered. So now in this case, we normally call them as contributories. So whenever we file an application, and we tell that these are the contributories, and these contributories have not used the diligence, and they are supposed to be contributing the loss which they have incurred for the company to the corporate debtor. Although this twilight zone or twilight period has not been defined in any particular legislation, but in common business parlance, it refers to the period of trading when the company has insufficient funds to pay its debt and is on the verge of insolvency. The period of financial distress where there exists a reasonable cause to believe that the insolvency may commence, and the directors have a duty to minimize the losses to the creditors and protect the assets of the company. There is a need to make the directors more diligent, prudent, and aware of decision making during twilight period. And IBC introduced specific duties that are owned by directors towards the creditors of their companies which are in financial distress. During this period, the transactions that are entered into by the company are vulnerable to scrutiny and might give rise to several liabilities on the part of the directors. So section 66 of the code identifies the twilight zone as the starting point of the period from the time when the creditors knew or ought to have known that there is no reasonable prospects of avoiding the commencement of corporate insolvency resolution. The twilight zone has serious business implications for any company because it determines whether the company will eventually emerge from this situation of insolvency or perish. So this is important. So the concept of twilight zone is only that this particular period is very, very important. In case this particular period the company is not protected, then it will be difficult for the company to revive, because whatever is left with the company, if the directors loses that money during the twilight zone, that means that the company will never emerge from the situation and it will perish. The decisions taken by the directors on behalf of the company significantly impact the outcome of the insolvency process when the company or its creditors formally commence it. Shift of duties of directors management from shareholder centric to creditor centric. During twilight zone, the duties of the management shift from shareholder centric to creditor centric. So in the fraudulent transactions, the orders that can be obtained, again, the person who actually were knowingly parties to the carrying on the business shall be liable to make such contributions. So the person who were knowingly parties to the carrying on the business in such manner shall be liable to make such contributions. So who were the persons who were liable to be known? Maybe all the KMPs, directors, management. That a director or a party shall be liable to make such contributions if such director had knowledge that there is a reasonable prospect of avoiding the company is going to commence a CIRP. Such director did not exercise due diligence. So this is the orders that we can obtain. First of all, we actually have to say that the transactions were incurred, transactions undertaken with the intent to defraud the creditors, transactions were undertaken during twilight zone, and the due diligence was not used. So the directors or the other KMPs can be called as contributories. The adjudicating authority can actually ask them and direct them to contribute that kind of loss to the corporate debtor. So when we are saying about 66, it is also important that we should also read section 69 of the IBC. Section 69 of the IBC talks about the offense, the punishment for the transactions defrauding the creditors. So whenever there is a transaction under section 66, or there is no reference of section 66, the only referred is who have made the transactions or have caused to be made a transaction as defined in section so these transactions, which are basically the fraudulent transactions, in such cases it will be considered as a prosecution. The prosecution would be started against any officer, and the officer is defined as per section 2 subsection 60 of the Companies Act. So when I talk about the all those persons, like let's go back a slide and talk about any person who were knowingly parties to carrying on the business, and then we go to section 69, which talks about officer. So any officer of the CD, which is defined under section 2 subsection 60 of the Companies Act, or in case of LLP, as defined in clause J of section 2 of the Limited Liability Partnership Act, those parties would be punishable for the defrauding fraudulent transactions, and the prosecution would be started. Prosecution would be started by IBBI under section 236 of IBC, because the prosecution can only be started by IBBI till now. I mean, later on, maybe there is another authority which might be responsible for prosecuting the for various offenses under the IBC. For the time being, there is a prosecution department under IBBI, and that prosecution department takes up all the criminal offenses and files applications for prosecution and trial before the special courts constituted under the Companies Act in 2016. I think there are about 29 such special courts which is already functioning under the Companies Act, and all these applications of prosecution will be filed by the prosecution department of IBBI to these special courts. So these fraudulent transactions, I think now I am coming to the various most common fraudulent transactions which we have experienced in our career. So Ankit, I think when we finish the transactions, or is there any questions so far which we can handle? Because we can only extend by 15-20 minutes, and I think we have already done, and we quickly handled because this was already part 2, so it was not possible to further extend it. So we have closed to the finishing line, but I think in case there are some questions, then I will actually use the most common fraudulent transactions that we have seen and we have reported to our adjudicating authority.
I think you can go ahead with this example, and that will solve.
That will clarify many doubts.
Yeah, because that will cover a lot.
Okay, so I will see whatever I have listed here based on our experiences, and it is not based on the adjudication because the adjudication is pending in most of the cases. Any transaction with the objective of keeping the assets or property of the corporate debtor away from the creditor, this is a very common fraudulent transaction. But by whatever means, if we find that the objective of this transaction was to keep away the asset or money of the company away from the creditors. Manipulation of the books of account or other records of the corporate debtor to deceive the creditors. When we say that the companies were making double balance sheets, when we also see that some transactions were, the books of accounts were manipulated, and the other records of the company were also manipulated to deceive the creditors. How a company can deceive the creditors? The company can deceive creditors by presenting a rosy picture, by giving them incorrect figures, by giving them fake figures, and the objective is to deceive the creditors to seek more funds and to seek double or higher drawing power against the working capital. Use of forged documents and records to obtain sanction and disbursement of credit facilities, like I said, the bogus exchange bills, sale bills for discounting, bogus export and import bills for discounting. These are definitely fraudulent transactions and must be reported as section 66 and 69, because in many cases that we are trying to find out these transactions which are apparently fraudulent transactions because the forgery is involved, the bills are made and without underlying transactions of physical movement. Falsification of books of account by recording fake transactions of sale and purchase for obtaining increased credit facilities from banks and financial institutions. When we falsify books of account, enter fake sale, fake purchase, just to swell the sale or balloon the purchase. So this is what is fraudulent transactions, where the intent is to defraud the creditors, to seek higher credit facilities by providing them the incorrect figures intentionally. Intentionally providing them incorrect figures to take more loan, that is also fraudulent transactions and must be reported. Falsification of books of account by making entries of bogus expenditure for diversion of funds of the corporate debtor for personal gains of the management. See, if some of the expenditures are found to be bogus, that actually means that the bogus expenditures are basically for the benefit of the intermediaries, for the benefit of the officers of the company, as defined under section 2, subsection 60 of the Companies Act. And these transactions are fraudulent transactions just for the sake of diversion of funds. Falsification of books of account with the objective will increase in the assets of the corporate debtor in the books of account to present a rosy picture. See, whenever we are trying to create a rosy picture by inflating the value of the current assets, such as stocks, sundry debtors, advances, claims, refunds, all these transactions are basically with the intent to defraud creditors, to present unreal financial statements, to falsify books of accounts, all this. And the intent is basically to take away the money of the creditors and run. Now, see the siphoning of the inventory of the company by showing increased consumption by falsification of books of accounts. And it's a very common example that I normally give. In 2017, the stock was 200 crores and the stock statement was being filed regularly to the bank, duly signed by the officers of the company. The stock auditor also verified the stock as 200. The statutory auditors also verified the stock as 200 crores. Bank also verified the stock as 200 crores and allowed the drawing power. Now suddenly the officers of the company came to know that the company would not survive and it has to go to CIRP, or the new law has come, or the company is going to go to SARFAESI. Then they would try to bring the stock down, otherwise they would be caught when the physical inspections would be done by the creditors or the RP. So they will bring down to 20 crores and the 180 crores would be shown as consumption in 1 year. In the subsequent year, they might even bring down the stock to 2 crores. And in this process, just by showing bogus consumption, and one can definitely make a case that in the earlier years, the raw material consumption was only 60–70%. Now the raw material consumption has actually shot up to 160%. And that's nothing but siphoning of the inventory. And that should be reported as a fraudulent transactions. Submission of fake financial statements to bank to secure additional credit facilities, that is a double balance sheet case. Siphoning away funds of the company by resorting to bogus transactions causing loss in the books of the account for personal gains. Some bogus transactions of purchase, some bogus transactions of sales continuously. And normally I'm using another example always, that if I'm just for the sake of reducing my stock, I keep selling to one party. I keep raising invoices to some party where I'm not getting payment from that party even for the earlier invoices. Continuously for 6 months, I'm selling the stock to one party where no money is coming. I don't think this is diligence. The money is not coming from a party, and I'm raising invoices only with the intent to reduce my stocks. This is a fraudulent removal of the stocks, and the fraudulent removal of the property of the corporate debtor causing the loss. Undervalued transactions with fraudulent intent that we've already seen. Lack of diligence during the twilight zone that we have already seen. So this is the zombie companies is also covered under such scenario when these zombie companies are the word is derived from the African mythology, where the corpse is said to be revived by the witchcraft. And the company, which is a kind of a dead body, is being carried by the officers of the company to the different kind of creditors, and they would probably showcase the company as a very healthy and rosy company. And in fact, that company is a zombie company, which will, according to the officers' understanding, that company will never come up. But they would try to give rosy picture. They will try to find new set of creditors to defraud them. And they would try to raise loans by kind of asset stripping. So this is a kind of an example of zombie company. And all this kind of actions by the officers of the company can be considered as fraudulent transactions. Beneficiaries of any recovery made under the PUFE transactions. This is one important part that I would like to discuss with you. If we understand section 44, the property to be vested in the corporate debtor. That means if I file an application to adjudicating authority for section 43 transactions, so section 44 says that the property would be vested back to the corporate debtor. So what I'm trying to focus now is that the beneficiary, who would be the beneficiary of any recovery made under the PUFE transactions, section 43 transactions, the benefit goes to corporate debtor. So I'm trying to emphasize circumstances where the company has gone to another resolution applicant. The resolution plan has been approved, and there is an order from the adjudicating authority under section 44, and whatever transactions of preferential transactions were done, that property is now vested back to corporate debtor. That means that the property has now come back to the corporate debtor, and the corporate debtor has been taken away by another company, another resolution applicant, and at that particular time it was not factored in, so that particular resolution applicant will stand benefited. So undue enrichment of the resolution applicant is not something that we should support. So under section 44 also, the order can be passed for property to be vested with other party or the RP or the liquidator. Section 47 and 49 says that restoring the position as it existed before such transactions. Section 48 says to be vested back into the corporate debtor. 48 says the release or discharge any security interest granted by the corporate debtor, benefit goes to corporate debtor. Restore the position as it existed before, set aside the transaction, requires any person to repay, that benefit also goes to corporate debtor. Section 66 says shall be liable to make such contribution to the assets of the corporate debtor. So all these transactions, like all the PUFE transactions, the benefit of any kind of order from the adjudicating authority will go to the corporate debtor. And when this order will come, by that time, the resolution applicant has already taken away the company, and the benefit of these transactions will go to the resolution applicant, which is not the intent of the creditors, which is not the intent of the entire process. So what we are supposed to do? We are supposed to do one thing that we are supposed to do is that in the see in case the company goes into liquidation, there is no problem, because everything whatever is recovered from PUFE transaction actually will become the part of the liquidation estate and will be distributed under section 53. However, in case of a resolution plan, any contingent recovery that shall not become part of the resolution plan, that has to be put in the RFRP, or that has to be specifically provided in the resolution plan. And it has to be insisted to the resolution applicant that any money recoverable or recovered under the PUFE transactions would not form part of the resolution plan, and that would actually come back to the creditors. RFRP can provide that such contingent recovery from PUFE transactions, and that actually would go to the that would not be part of the corporate debtor. The resolution applicant can be told to add this clause in the resolution plan, so that the resolution applicant does not claim this amount later. Then the other part is the very, very important part, which probably a lot of people would be asking, or they have it in mind, that how do see when a resolution plan is approved, the company has gone to a resolution applicant, the application under section 43, 45, 50, 49, 66 are still pending. Even if there is an order by the adjudicating authority, the appeals lies before the NCLAT or before the Supreme Court. Till the decision is arrived at, there may be another 1 year, 2 years is spent. There may be some expenditure incurred. So there are questions. One question, that if the resolution applicant takes away the company, who will handle the applications under PUFE transactions? Second, who will bear the cost of the litigation under PUFE transaction? 3, whatever the recoveries will come, how it will be distributed amongst the creditors, and who will distribute? 3, So all this has to be resolved before a resolution plan is approved. All this has to be resolved before a resolution plan is approved and has to be submitted to the adjudicating authority so that it is mentioned in the order approving a resolution plan. So what we need to get mentioned, what we need to present before the adjudicating authority. Number one, that the entire litigation would be handled by the resolution professional, and resolution professional would continuously would continue and would be authorized to handle the litigation, would be able to appoint lawyers, and would be able to even pay their fee. Second, the CIRP cost, there should be an estimate of the future expenditure in the CIRP cost, and that kind of money should be kept as a reserve with the RP, and with the condition that any money saved will go to the creditors later on. 3, the resolution should be passed in such a manner that any money recovered from PUFE transaction would be allocated to the creditors in this ratio. All these resolutions should be submitted to the adjudicating authority along with the resolution plan. Though these conditions should be mentioned in the order finally. Then the PUFE transaction applications can be pursued, the fee can be paid to the lawyers, the benefit can be distributed to the creditors. Otherwise, all these PUFE transaction applications will actually be will remain unattended, and the benefit will go to the fraudulent promoters. So this has to be very, very carefully handled, and this cannot be ignored. So any resolution plan, while approving the resolution plan, we actually have to consider all these three parts, maybe, because it's very important for all the resolution professionals who are attached with us, who are connected with us, that this is important, that we should provide for the CIRP cost, that cushion of the money should be available with the RP. RP should be authorized to handle the litigation in future. Money, whatever is recovered, should come to the RP, and it should be distributed to the creditors. So there are guidelines that we have received under the Supreme Court order, and that is the Anuj Jain for JP Infratech, and that order provided us a lot of guidelines in February 2020. One, that the combined application under section 43, 45, 66 should not have filed, as the degree of examination in preferential and undervalued and fraudulent are different. Supreme Court has directed that the applications under section 43, 45 and 66 should not have been filed as a combined application. So each application should be a separate application, 43 separate, 45 separate, 50 separate, 66 separate, because the degree of examination is separate, different. Secondly, the preferential transaction, the intent is not involved by the virtual of legal fiction of the deeming provision, whereas for undervalued transactions requires a different inquiry under section 45 and 46, in which the adjudication authority to require to examine the intent if such undervalued transaction were to plead. So specific material are required to be pleaded if the transaction is sought to be brought under the mischief sought to be remedied by section 45, 46, 47 or 66. The adjudicating authority would have examined the aspects of preferential, undervalued and fraudulent separately and distinctively. So applications are supposed to be filed separately. In the case of Raman Agarwal versus Mohit Chawla, which is a January 2020 NCLAT application, it is very clearly said that there is no provision to file any company application under the NCLT rules. Hence, for the adjudicating authority, that is the NCLT of the country, will never entertain the company applications in insolvency matters. So in insolvency matters, we actually have to file an IA, whereas in the company law matters, we actually have to file a company application. So this is also should be kept in mind. In an earlier case, the NCLAT has held in the case of Anup Kumar, a resolution professional, in the case of Shivkala Developers Private Limited, and they're saying that the single application was filed, multiple allegations of the transactions were also raised, transactions found to be under normal business, and no action was taken in all these cases. So I think what I wanted to say, Ankit, is all over, because now I have the flow of application, which I don't think I would be able to handle. It will be too late then, because I actually have prepared a flow of transactions, like what kind of facts and what kind of flow, what kind of information is required to be given to adjudicating authority for an effective order. So the most important part that I wanted to say again is the handling of the litigation after a resolution plan is approved. So Ankit, we can take some of the questions, and I stopped sharing my PPT and I can see in case there is any
transactions. One question from Mr. Arvind Garg, that transactions under section 43, 45, 50 older than 2 years can be reported under section 66. That is, you want
I think we actually have to see the intent to defraud the creditors. If there is an intent to defraud the creditors, that certainly can be, and that transaction has to be then qualified as under section 49 or 66, and it is not really just 1 second. So this is not a transaction. See, if the transactions can be covered as an intent to defraud, then of course it has already been held in orders that for section 49 and section 40 and section 66, there is no look back period.
Then a question that what is the difference between section 49 and 66(1), as both talk about intent to fraud the lender?
So as I said, that section 49 only deals with the transactions as defined under section 45. And that means that the transaction should be for a transfer of an asset or a gift of a corporate debtor, gift by the corporate debtor. So if the transaction is for a gift or for a transfer of an asset with the intent to defraud the creditors, then it is a section 49 transaction. All other transactions that I have said, like any rosy picture, falsification of books of account to defraud the creditors, everything else is section 66 transaction.
Hina Talwar, the question is, can we have example to differentiate between fraudulent in 66(1) and wrongful in 66(2)? Also, as stated in 66(1), business of the CD has been carried on with the intent to defraud the creditor. So does it apply only to the management of the CD or covers outside parties with whom transaction has been entered? Also, and what are the consequences thereafter for such outside parties? So I think she has multiple questions. One, she wants to ask in case 66(1) has any replication for third parties.
I think it is very clear that any person, whenever it is written any person, like we can again, I think this is a good question. So I think we should spend some time on this. Now the 66 starts, if during the CIRP process or a liquidation process, if it is found that any business of the corporate debtor has been carried on with the intent to defraud creditors of the corporate debtor or for any fraudulent purpose, the adjudicating authority may on an application of the resolution will pass an order that any person who were knowingly parties to the carrying on the business in such manner. So that means any person, it is not restricted to the officers of the corporate debtor.
Yeah, so it can include anyone and everyone who might have participated in saying that this business is not solvent. Yes. But he did not say that.
So when we talk about section 66(1), it is any person, and we talk about section 66(2), that is only for the directors where they have to use the due diligence to run the company and to minimize the loss during twilight zone. Section 66(1) talks about any person with the intent of any fraudulent transaction. Section 66(2) talks about the transactions done during twilight zone by the directors, because they are supposed to be more diligent during this period. And so in case they are not diligent and they are not able to minimize the loss to the corporate debtor, so they can be asked to contribute. So there are two separate sections, 66(1) and 66(2). 66(1) for any person, section 66(2) only for the directors.
So whether one can appoint a family CA firm or father and brothers as transaction auditors, I don't think that is something that there will be a clear conflict of interest, and IBC doesn't support that in any way. Can payment made to operational creditors within relevant time be considered as preferential transaction where the operations were discontinued 1 year before the payment made and purchase also made 1 year before?
I think this is again a case of old operational creditors getting the payment.
Yeah.
Old operational creditor getting the payment when it is not related to the when it is not related to the normal business transactions, and it is also not for the purpose of keeping the company as a going concern. Yeah. So that's clearly a preferential transaction.
Yeah, so I think I have taken some of the questions that I thought are relevant.
Again, I think we had committed that we will finish within 2 hours 30 minutes. So we are already on 27th minutes. So with 3 minutes we'll spend on just thanking everyone for the love and affection that they are showering on us, for making a lot of registrations and for motivating us. And you remain connected with us for the entire period of 2.5 hours. And I received a lot of messages. I received a lot of emails. I thank all those people who send me emails. And I'm also apologize in case I'm not able to answer some of the emails, and thoughtfully so, because I think that those people will participate and ask their questions. That is the reason that we we are practicing a model that every 30 minutes we would be taking the questions. As we are receiving a lot of compliments on the chat box, everyone is saying thanks, everyone is saying informative, everyone is saying heartiest congratulations. And I would repeat along with Ankit Goel that whatever we are doing, the only objective is, the only and only objective is that this is our way of learning and no more objectives. Thank you very much, all the participants. We have conducted the last real estate IBC, and the part 2 of the real estate IBC would be conducted on Saturday, and that would be the Saturday, coming Saturday at 6 p.m. After that, please watch on the personal insolvency for grunters. Personal insolvency for grunters is a very, very hot subject now. Most of the banks have decided to go after the personal grunters because the insolvency is, for some time, it is on a little bit of slow path. But the banks have got the direction that all those people who actually have given guarantee to secure any loan to corporate debtors, those should be proceeded against. So we would be coming up with 2 or 3 webinars on personal grunters, insolvency and bankruptcy. Thank you very much. Thanks a lot for...
Thank you, everyone. Thank you so much for your participation. Thanks.